What a wild week for banking. As you may have heard, late last week, Silicon Valley Bank collapsed and was taken over by the FDIC. So let's talk about how this happened in the first place, what's happened since then, and watch until the end to see how this affects real estate. So what happened with Silicon Valley Bank? Well, here's the simplest version possible. When you put money into a bank, they don't actually hold the majority of the money, but lend it to other customers or invest it in mortgages, small business loans, US Treasuries, etc. to earn income. In fact, for every $100 we deposit into banks are only required to hold about $10 on hand to spit out of ATMs, give cash at the window, or transfer between accounts. SVB provided banking services for a significant number of tech startups and established tech firms, and when a few prominent members of this community suggested companies remove their cash from SVB, it caused a classic run on the bank. That means that more customers were requesting cash than the bank had on hand. So, to raise cash and handle the customer demands, SVB was forced to sell $21 billion of their investments. The problem was these investments had become less valuable than when they were purchased and were sold at a huge, almost $2 billion loss. When this became public, more customers started requesting their cash. As this unfolded, all within just a matter of 48 hours, the FDIC, the government, eventually stepped in, took over the bank to stop the run, and tried to find a solution. Here's what's happened since then. The Federal Reserve stepped in Sunday night and created a massive backstop for every bank in the country that could run into a similar issue. This should essentially eliminate the possibility of any additional significant bank failures. But this could lead many banks slowing down their portfolio lending to increase their cash reserves. SVB reopened Monday, March 13th, giving all insured depositors full access to their insured deposits, while uninsured depositors will be paid an advance dividend within the next week. President Biden stated no losses would burden taxpayers, and that's one of the key differences between last week's collapse and 2008. And this is worth mentioning. There was no known fraud or anything malicious at SVB. In fact, they had invested most of their money into fully guaranteed US Treasuries and mortgage-backed securities. The issue was, as rates went up, they didn't reduce their already industry-high percentage of holdings or hedge them, but simply held on to those mortgage-backed securities and US Treasuries. Now, when rates go up like they have all year, the market value, what you can actually sell them for, goes down equally as fast. This isn't normally an issue for banks that hold the securities and collect interest payments. It's only an issue when you must sell them, like in the case of SVB. Many questions are still lingering, but one thing is certain: world markets will experience volatility in the coming weeks. What does this mean for real estate? Well, we can expect mortgage rates to drop even more this week. Last Friday, the US Treasury yield quickly dropped in response to the SVB news. In turn, mortgage rates declined almost 0.25%, bringing the 30-year fixed rate to 6.76 at the end of week. As rates continue to fall, we could be back to 6% mortgage rates this week. So, if you've been wanting to lock in your rate, here's your chance. And sellers, this might mean it's time to act quickly and get your property in escrow. The lower rates combined with pent-up buyer demand means more opportunities for you.